All right, so welcome to session 16 of the Precision Traders live training sessions. And if you're watching this in recording, well, welcome to you as well. It is Thursday night, 9 p.m. Eastern. Well, it's actually 9:09 at this point. I apologize for being a little late. I'm having some issues, but we're going to band-aid this and power through it no matter what anyway. Hey, congratulations, Douglas. I hit mine 2 weeks ago. So, twins, though. That's exciting. Congratulations. Jonathan, interesting story. We'll talk about that a little later. Appreciate you guys cutting some time out to be here tonight and watch it live. All right. So, as you can see, the agenda for this evening, last week we didn't have time, or Tuesday morning, we didn't have time to finish off the haul. So, today I want to come back to the haul. But before I do, I want to talk a little bit about multiple time frame and give you some thinking there because that will then make the whole conversation a little easier. And then we're going to do something a lot of traders have been asking before. We're going to talk about Fibo levels. So if that's okay with you guys for the agenda tonight, that was a question. And you know what? If it's not, go friggin' somewhere else. I don't care. No, tonight's gonna be an informative night. All right, so let's talk multiple time frame analysis. And that's really a buzzword. It's really or a buzz phrase. It's really more about just understanding, you know, what's going on. You don't have to do too much analysis. We talk about as an approach to your trading is to come down and look at your charts and for, one of the many types of configurations a trader can have. We've got this 3 up and you may have more or less, but we have to have a teaching point. We can't teach 27 different trading configurations or monitor configurations, chart configurations. So this the 30-minute, this the 15, and this the 1. Now look, for those of you who are here or who have shredder influence, um, realize when you start off with shredder that your orientation is 30 and 5 only, and then you migrate and grow inside shredder, and then you go to 30 and 10, and then you go to 30, 10 and 1. The evolution to 15 instead of the 10 is for those that are going to be playing around with harmonic scans, which I would encourage you to be doing. Those from IML in here know that is a requirement for this group to have your membership active. There's 2 reasons for that. One, I don't want anybody to ever think I was poaching IML for business. I don't need to do that. And I don't want other team leaders angry with me because you guys quit IML and took business away from them. My goal is to make you a successful trader using IML tools so you are motivated to stay in IML. Secondly, the IML scanner is necessary because that is more and more and more of our focus as we move on. Yes, pitchforks are going to be part of that, and yes, tab 29 is going to be a very big part of that. But we've got some really cool stuff going on here, and in that regards, I have a big announcement tonight to talk about that. So with that, let's talk a little bit about our multiple time frame analysis in the setup that we normally have for precision trading, which is the tab 29 setup: 30, 15, and 1. If you're an old shredder trader and you're in here, you need to get used to 15 instead of 10 in the middle. And that means putting on your 15-minute chart. It will auto-diagnose for multi-wave and tab 29 and put the 15-minute wave, which is orange, on your chart. You will have to manually go to the 1-minute chart and add the power 15 and delete the power 10. I would discourage running both, but hey, your choice. I also discourage power 5 on the 1 minute. I know some traders do it. It is an option. You can be allowed to do it. I can't stop you. But tab 29 was designed to declutter multi-wave, and unless you're really using it in almost all your trades and you have a way of using it that doesn't take away from your 15-minute trading, then I wouldn't use it. But if you're using it and it's providing value, then I would use it. But for the average trader, it just clutters things up, and it's not going to make that big of a difference in your trading. So on your 1-minute chart, 30, 15, and 1. All right. So multiple time frame analysis. So we've talked about coming to your charts, and the first thing you want to do is look at your charts, not the indicators. The indicators should be the last thing you go to. Okay. You want to look at your 30-minute chart and and see if you can figure out what's going on. Direction, when the last convergence was. I would take a peek at a 4-hour chart. It may not be in your main layout, but I would take a peek at one. Try and see where the 4-hour wave is. Get a flavor for that, what it's doing, where it's been, the degree of movement, how many pips it's gone from convergence to convergence. Just try and get a sense of what's going on. So if somebody said, hey, give me a book report of what you see on the 4-hour chart, you can do it. Nobody's asking you to make forecasts where it's going. First of all, we don't believe in that. But just have a sense of what's going on. Then jump to your 30-minute chart and see if you can figure out in the last part of your 4-hour chart if the 30-minute chart, where it's at, makes sense. Do you understand what's going on with the 30-minute chart relative to the 4-hour? And then you just want to get a sense for your 30-minute chart. Do you have your Fibo work from your 4-hour charts with visibility on so you could see it on your 30 and your 15 and your 1? Look at your 30-minute chart. There will be Fibonacci moves, there will be swings inside the bigger 4-hour swings. Pick the one that is currently dictating price. What do I mean by that? If you have a chart that looks a little bit like this, didn't mean to even draw a double head and shoulders in there. If you have a chart that looks like that, what you want to do is have a Fibonacci on this level and on this level. The last Fibonacci to where the high and the low have totally contained price since the last high and low. So price remains inside this channel described by the swing low and the swing high on this chart. That's the one you want to put a Fibonacci on. Roxy. She's gone a little crazy here the last few weeks. I don't know what her problem is. So that's where I would put my Fibonacci. I will then have my 4-hour Fibos. You do the same thing. And some of those will be showing up on some of these Fibos. Those would be called Fibonacci clusters, and you want to highlight that. You want to keep that in your head. I would also then, on my 30-minute chart, if I haven't already, I would draw the most current swing and a pitchfork for it. Hopefully your lines are a little straighter. What's from the 4-hour chart? I didn't look at the questions. I'm sorry. The Fibo in yellow is on the 30-minute chart. That's why it says 30 in the upper left-hand corner. And you take the largest swing on your 30-minute chart. That's where you would like to see your Fibos. You do the same thing for the 4-hour chart. They're not going to be the same swings, obviously. Okay. Sorry about that. You then drop down to 15 minutes, and do you guess what you might try there? You would have your transparency for your 30 turned on, so you see how it fits your 15. You would draw your 15-minute Fibos and your 15-minute forks, hopefully based on the most recent scan or in front of the next scan as a BS fork. But if you have a current scan there, you should be working the Charlie Delta and the X-ray Alpha forks. They should be on your chart. And then, of course, you can pretty much see what's going on the 15-minute. The 1 minute would just be for fine-tuning and trade execution. Roxy, another toy. Get another toy. Don't look at me like that. If it's not Trading Cat, it's the dogs. So that's your chart work in terms of understand what's going on. Once you get down to having got all that, then I come back and I will look at tab 29 progressively from higher level to lower level. And I want to see if I can figure out what's going on. Hopefully with your forks on tab 29, you've worked hard as possible to ensure the tops of your forks are at convergence points and the bottom of your forks are at convergence points to try and measure your fork. You're not always going to get that, but it's something you strive to. Tab 29 on your 15-minute chart. See, you almost got me saying 10. So much of a habit. Tab 29 on your 15-minute chart. Where are the waves? Do they reflect what you see on the chart? Were the waves indicative of the swings that your scan is showing you? Zoom in to see your scan. You want it to be at least that big for your initial field of view. I'm looking at tab 29 on my 1 minute chart, and I'm trying to see the most recent price move and is it making sense? You know, if I have this piece of the 1 minute in my field of view, then I'm going to see and realize it's going to be stretched out some. You know, it's not going to be quite as steep, but that's going to be my. So where is that? How do the 15-minute waves that I see over here, how are they matching up on my 1 minute chart? What kind of convergences look like? How clean were they? Can I see the PO10 of some of the 10-minute moves? Does it look clear? Look for the pullbacks of the 1 minute wave. Can I apply pieces of 10 technology? Even if you're not trading straight pieces of 10, can I get some trades here and there? You know, on this move up, do I see some bottoms on 1 minute waves? Are they POT compliant? Do I have higher lows? If I have lower lows, you want to be checking for divergence, because almost always When this price pulls back and you get a lower low, a higher low up here and a lower low down here, you've got divergence. Some of you might have seen my comments on Ben's charts today. I might have shared that. You just want to see what the waves are doing on each chart. Do they make sense for what the price is doing? Make sure you see scale. Try and get your 1 minute chart to 5 pip price channels on scale. Try and make sure your 1 minute chart has a minimum. We'd really like to see 12 to 15. It's totally danger zone for anything less than 10. But I personally like to target 12 to 15. Rough. It doesn't have to be to the pip. It doesn't have to be a perfect zone, a trend line. As long as I can see the estimate of the channel. And I want to see what price is done. That's going to help me decide what kind of trades, how late I could be, how much risk is in there, and reward is in there, so I can make sure my entries match the risk reward. Ideally, even on your 15-minute chart, you don't want to see your candles way too big or wicky. 1 minute chart, you'd like to see your average candle 2 to 4 pips. Yep, 2 to 3. 2 to 4 pips. Again, not a lot of wicks. Wicks the size of the body of the candle are bigger or danger. Wicks out of both ends are danger. Might be a time to look at another pair. Start this process over on another pair. Do not come to your desk, look at this monitor that has these 3 charts, and have your eyeballs instantly go to tab 29 on your 1 minute chart. You will mess with your RAS, your SIGs. You're going to see stuff here that makes sense that may not be tradable, even though tab 29 is saying, oh, the peak one is flipped. Oh, the trend bars have flipped. It might not be tradable because of wicks, because of width of channel. Because of reward to risk. So that's doing a little bit of multiple time frame work. I can't call it quite analysis, but it is work. All right. So one thing you can do then is slowly shift into some multiple time frame analysis. And this just makes good sense. Not just because I'm presenting it. Yuck, yuck, yuck. But it makes logical sense. And you want to start, I would start this from the bottom and move up. So I go to my 1 minute chart. So we still have the same alignment, 30, 15, 1. So I start on my 1 minute chart. And I'm going to look at a combination of things. One of the things I want to see is my 15-minute / 30-minute Fibo work. I want to see where those lines are on my 1 minute chart. Now remember, we can already see where price currently is. We know where price currently is. And if it's right there, what I'm interested in, and look, if your candles are 2 to 4 pips in length, we can say an average candle is 3 pips. Your reaction time on a chart should be under 3 minutes. That's like a beginner level. Well, beginner's a little slower, but anybody that's been on charts for a couple months, the reaction time should be less than 3 minutes. In other words, if I said, oh, look at this, I want you to look at something. You should be able to do that within 3 minutes and quickly be moving towards being able to do it under 2 minutes. That's 120 seconds. The kind of thing I'm talking about is, oh, put on a stochastics RSI. Let's look at that real quick. So you need to be able to get that done in less than 2 minutes. And then as an advanced trader, you need to be able to handle that under 1 minute. So for the newer trader to the intermediate trader, where you're, trying to be responsive less than 3 minutes, less than 2 minutes, what does that mean if our average candle is 3 pips and we have a 3-minute response time? What that says is essentially, I want to be able to predict something on the upside that's 10 pips away and something on the downside that's 10 pips away. Does that make sense? So now, because I can do that, I have that response time. And again, that's the barely acceptable, guys. I mean, that's the, you really want to be in here very soon. If you're not already at the level you're at, you need to be in here. So this zone's get a little tighter. Instead of 9 to 10 pips each way, we're talking 5 to 6 pips each way. If that. 2 minutes in each side. 3-pip candle. It's going to be 6 pips. 6 pips up, 6 pips down. So now I want to see where my 15-minute Fibos are and my 30 in relation to the zone that is in my reaction time around my price. I.e., oh look, here's the 15-minute 61.8. Oh look, here's my, drew this backwards, here's my 30-minute 23.6. Now you may see some potential support and resistance, PPP, potential support and resistance, in your zone of reaction time. Everybody with me? Let's see who's sleeping. We making sense so far? Okay. So, one thing I can do is go to my 1-minute chart and draw some pitchforks. I know that sounds odd, but just trust me. I'm not looking for 5-pip channel pitchforks. Roxy, hey. Draw some pitchforks. Only be looking at your 1-minute chart. Yeah, she does want to play. Only be looking at your 1-minute chart. Get a pitchfork or two on here. Traditional, if it's best fit, look, we're not waiting 2 hours, 3 hours, 2 days to have a best fit and to go back and adjust it. This has to be a best fit that based on previous price action, when this thing moves 5 to 7 pips this way or 5 to 7 pips this way, you have a trade entry. So you have to have a traditional or a best fit that's good to go. If I have a best fit, if I have a traditional that's good to go, now I can actually do some multiple time frame work. And I'll tell you how that works. Probably be able to guess. So what I'm going to do next is go over to my 15-minute chart and draw some pitchforks there. Same concept. Something of immediacy. Not something I'm going to wait 3 days for. These are tighter forks. If I have my scans and I have my Charlie Delta or I have an X-ray alpha, I want to see if there's potential for when this price hits this median or this price hits the lower parallel, do I see some sort of accompanying hit on my 15-minute fork? It doesn't have to, it's not going to be the same fork. The lower parallel here on your 1-minute chart might be a quad on your 15-minute chart. It might be the median. But the point is, do I see on my 15-minute chart some support and resistance level that's here? Now, once I have my 15-minute pitchforks on, I could go back to my 1-minute pitchfork and format it with visibility up. Oh, let this fork be seen on 15-minute charts. I don't want to do that. When I first draw this fork, its visibility is limited to the 1-minute chart. Bring that slider on the minutes under 15. So when I draw this, it's not showing up on my 15-minute chart. Go ahead and draw your 15-minute forks. Once you have them drawn, go back to your 1-minute chart and change the visibility so it shows up on your 15-minute chart. No, Larry, what I'm saying is the fork you put on your 1-minute chart is ready to trade. And that means it's either a new traditional or an existing traditional, or it's a best fit from far enough back that the points on it already validate the exact position of the fork. It has to be tradable at the time I put it on the chart. Does that make sense? We don't want to see anything bigger. We don't want to see this fork on anything bigger. We want to get it right on the 1-minute chart. We want it to be tradable at the time we put it on. And then we want to see if that's going to match up on our 15-minute fork. Whoops. You may have bounces on your middle of your 1-minute fork that are not trades. Because remember, the 1-minute wave fits inside the 15-minute wave several times. We're just like harmonic wave convergence. We're looking for a 1-minute fork whose major touch, upper parallel, median, lower parallel, is going to coincide with the touch on your 15-minute fork. Essentially, we have a convergence based on our forks. Yes, same thing. I could be trading 30-minute charts. What I would want to do in 30-minute waves, I would want my 15-minute and 10-minute forks to be tradable now. So I do back work, reverse forks, ghost forks, traditional forks, anything to where wherever price is, it's sandwiched by one of the two lines. It's either in the lower quadrant or the upper, or the lower half or the upper half of the fork. So it's sandwiched by at least two lines, and therefore it's going to hit one of those two lines at some point. It has to. But it needs to be tradable. Then do the same thing. Go to your 30-minute chart, draw your 30-minute forks, go back to your 15, turn on visibility to include 30. Now I'll see my 15-minute chart and where it's coinciding with my 30-minute chart to create energy points of intersections between those two forks. And yes, if you want to trade 240 waves, you would draw your 30-minute pitchforks ready to trade the best you can. Turn, no visibility upwards. Draw them, get them ready. Go to your 240 chart, draw your 240 pitchforks, go back to 30, turn on visibility to include 240. You're visually doing what multi-wave is doing behind the scenes with the data. You're trying to find points that multiple time frames are hitting on, because that brings credence to that point. It brings more viability to that point. Everybody with me? It's pretty easy to do. It's just a little process. It's fun stuff to do. It's not a chore. If you can't enjoy doing that, drawing forks and seeing if you can make them, sometimes you'll draw that 1 minute fork, make the visibility to the 15, and you'll look at your 15-minute chart and say, oh, yeah, I see something here. Maybe if I adjust my one, and you go back and you make a move on your 1 minute fork, and now that fork makes more sense, and now it gives you your 15-minute hit. But don't force stuff that's not there. It's got to be there. So this is just a good example of you're staring at the charts and you don't have anything to do. Well, you're going to make your future trades more strong. And guess what? Your 30-minute fork is going to hold for a while. Might even hold for days. Your 15-minute fork is going to hold for quite a while. Many, many hours. Maybe days. Your 1 minute fork can be changing out pretty frequently. But that's so once you do this process, it's just and then and look, you don't have your 15-minute chart turned on so 1 minute chart sees it. You don't want that right now. You're not trading right now. You're doing analysis right now. So when I draw my 1 minute fork, it's not showing up on the 15 until I finish because I don't want the bias of the 15-minute fork helping me at the 1 minute level. That's gonna have you to have a tendency to force things that aren't there. It's close enough. If I do this, it'll make that touch there. And no, you want no influence on your 1 minute chart while you're drawing the forks. You want to get it right. Then you turn it on so it shows up on your 10-minute or your 15-minute chart. And if you get a match there, then you can turn your visibility of your 15 on so you see it on your 1 minute chart. So now you're ready to trade. Then it becomes trade executable. All right. Any questions on that? All right. Let's get into the haul. And this is so easy that I should be through this in 5 minutes if it takes that long. The haul is not a magic bullet in and of itself. The haul is to be used when you have pips in hand and there may be an opportunity for more, but your indicators will not allow that opportunity. Let me give you an example. One-minute chart. The 10-minute wave by itself loses its ability to be measured when it hits its extreme. At this point here, We don't know if the 30-minute wave is going to finish its convergence and do a reversal. We don't know if the 15-minute wave is going to come back and retrace some, not going into this move at least. Not coming into this point, we don't know what it's going to do. Maybe it's just going to retrace a little and then take off. Maybe it's just going to do a little T4 action, just barely move down as soon as we get in and then take off. Don't know. Don't know. Don't know. So when I get to the top here, if I was in this trade, when I get into the top here, we could pick a number and it doesn't matter. Let's say it's 12 pips. Let's say it's 17 pips. Doesn't matter. There's options here on what you can do, right? You can exit with all your pips in hand. Two, if this had been a bigger gain, you can CBT it. I'm not sure I'd want to do it at just 12 pips, but three, so that would be CBT and stay. Three, we can say, let's think about this for a second. I know the haul over the long haul will average about 23% retracement before it takes me out. See, so what's going to happen somewhere in this trade from the time you got in, if I do this a little bit more accurately, oops, from the time you got in this trade down here, somewhere, not too far up, and it depends on how far price came from. Because on average, it's going to be 23% of the way of a retracement of that down move. All right, it's going to come down here at about 23%. This thing's going to flip green if it was that big of a move. So somewhere in your trade, we're going to get the candles enough to turn this thing green. Now it's in the direction of our trade. We're not trading the haul at this point. We're trading either pieces of 10 or 10-minute wave convergence to convergence. What we're doing in here is not significant to what I'm talking about. What is significant is you get to the 10-minute convergence point and you're at 12 pips or you're at 17 pips. So now some simple math says the haul's already in my favor. I can measure the flip. You don't measure the flip from here. You measure from the bottom of the move. From that move to the top, 23% back before I would exit the trade. But we're not using it here to exit the trade because it's not going to flip that fast for us. It's not going to flip at the time of convergence. You have to realize that. It's not an entry-exit mechanism. It's only an exit mechanism for us. So, here we go. We're sitting there at 12 to 17 pips. If it decided to start turning around, because this really was a convergence and price was going to come down, what's 23% of 17? If it's going to snake, it will almost inevitably be much more than 3 to 4 pips. In other words, if it's going to snake and go higher, it's not just going to be 3 pips higher. That's not what a 10-minute, that's not a snaking 10-minute move. Generally, you're going to see it start to snake. The 1-minute wave did converge. Oops. 1-minute wave did converge. On this pullback, when it hooks back on you, now you've got a slingshot. Price movement up is going to be very disproportionate to that little tiny bit that's left. If this goes to another high from here, it's probably going up here somewhere. So if the Hall has already flipped in my direction down here, I'm not interested in using it until I've gotten to where I can no longer measure my 10-minute wave. And by the way, this is my 1-minute Hall that we're talking about. I have no need to use it until I've gotten to the max of what I can see on my chart with a 10 or 15-minute wave. Does that make sense? This is the mainstay of what I'm looking for. I don't care if it's pieces of 10. I don't care if I'm going 10-minute wave, convergence to convergence. That right now is my target profit. I'm not worried about the Hall at all. Other than I've seen it flip in my direction on the way up to my 12 or 17 pips. So now I'm at 12 pips, 17 pips, whatever. I get harmonic wave convergence. The risk says even if price started to pull back within 3 to 4 pips, my Hall would probably flip and I'd be out of that trade. Now, granted, it's got to be on a candle close and it might stretch out a little bit more than that. But the likelihood of it going higher is in your favor. I just have no room, especially once you see this thing starting to snake. So the mistake too many of you make then is when the 10-minute wave gets to its first convergence here, you're exiting the trade. First of all, if you wait for the bars to flip, you're going to minimize any further sliding up because you should catch the slide if you wait for the bars to flip. You may get the bars to flip and then it turns right around and goes up, just like that's why I drew this little dip down here to tease you with that. Your bars may actually flip here, flip red. And if you had entered that trade, you would have been stopped out because it's a T4-like action. It just comes down a little and continues upward. So the Hall at the 1-minute level is designed to get you past these moves with pretty much more reward than risk. In other words, if you got out of here if you relied on the Hall after this convergence and it turned around and came back and took you out, the amount of risk you're putting at play there is at least minimum to the gain you should make should it continue to slide up. The reality is that's why I say minimum, because it could be 2-3 times that. The problem is you have to remember, here's the key. The Hall moving average is an overlay. It has nothing to do with harmonic wave convergence. It doesn't know that you have harmonic wave convergence, be it multi-wave or tab 29 on your charts. They are independent. The Hall is crap at learning where to enter a trade because it's going to have slush, 23% worth from the previous move. Harmonic wave convergence gets you into a trade in that slush, very timely. Exiting the trade, harmonic wave convergence is not always the best indicator because we run into this area where if price has upward momentum and the 10-minute wave shows strength expired, it has no way of saying, oh, there's more strength, other than to show it by snaking. So it's at that point that you would consider using the 1-minute Hall. It's going to be personal. It's going to be risk-based. But if you're in a 10-minute trade that stretches out, and they can, especially if it's a 30-minute wave, see what essentially is happening here is you're giving yourself the opportunity to transfer what you're trading. If I have this convergence right here and I set my target at the opposing 10-minute wave, you're acknowledging, and you're going to exit there, you're acknowledging you're not interested in the 30-minute wave. But you just may have enough growth and strength in the 1-minute haul that if you say, okay, at this point here, I will start using you, and the 10-minute wave has just a little bit of a retrace because it's going to go to a higher high pretty fast, that retrace may not be enough to take you out. It might not come back fully 23%, 25%. Remember, that's an average. So for every time it's 17, it's got to be 29 up here. It's got to be a deeper pullback. So sometimes there will be pullback and the haul hasn't flipped yet. Plenty of time for the 10-minute wave to have done its retrace and move on, because this is a 30-minute wave. So now, how do I, so what you're just saying is, I'm using the 1-minute after I get to convergence. I don't need to use it before, because this is my take profit. This is my target place, my target price. I don't want anything else to disturb me until I get there. 1-minute POT, yes. Trade your hookbacks until you get to convergence. That's my target. But if I'm in a trade at that target, and it was a 30-minute convergence, this thing may continue to grow, because it's cycling the 10-minute wave up, the 30-minute wave up, excuse me. The 10-minute moves are cycling the 30-minute wave up. A little pullback here, now it's headed up. Or maybe another pullback, take the 30-minute wave up. So you entered this thing, pieces of 10 or a 10-minute convergence to convergence, and all of a sudden now you realize it's going to grow, which means it really is the 30-minute wave that it was down here. Your 10-minute, 1-minute ability to measure this thing in multi-wave is gone. And now the question is, well, is this 30-minute wave really going to get up there, or is the 30-minute wave going to come down? Is it going to go up, or is it going to come back down? Never made it up really high. That can happen. Once again, question point. Risk reward. But at that point, if this thing does a little retrace, it doesn't back up the haul enough, and you're up here and the haul's still running green with you, and you're on your 1-minute chart, what is the time to switch to your 10-minute or 15-minute haul? This is what you guys aren't thinking about in terms of multiple time frame analysis. There's a real precise way of knowing this. You can look at the old pip tables. I built pip tables for SBT, and I started to build new ones here, and I said, no, it's teaching the wrong thing, because that's not really what a real trader is going to do. And what you need to do is simple enough. It's not some big overwhelming thing, and it'll make perfect sense once I explain it. Yes, Michael. Yes, exactly. You are on the 1-minute haul until such time your 15-minute haul is now in your direction. And that's going to have a range. That's why it's always been a range. 15 to 25 pips, 20 pips. It's always been this kind of seemingly subjective range. Well, for the given moment, forget averages. For the given moment, you know precisely when you can move from the 1-minute to the 15-minute haul. And that's when your 15-minute haul turns in your direction. So when do you think you'd leave your 15-minute haul to go to the 30? when the 30-minute haul flips in your direction. Yeah. Now there'll be times. Let's talk about that 30-15 for a second because I want to get something clear because some people may be smart, have experienced this, or can hypothesize this as an objection. Steve, I've seen plenty of times. I just go look at my charts. I see plenty of times where that 30-minute wave is up here and, it does this and turns right around and goes green. And it goes green for a while. So if I just started using the haul here, I said, okay, 15, you're done. I'm going to trust the 30 now. If I do that, I would have been taken out there. And you know what my answer to that is? Yes. But guess what? If you were still on your 15-minute haul, you might not even made it to that point. You would have been taken out earlier because your 15-minute haul would have already flipped. At the time this thing is just starting to flip, your 15-minute haul would have flipped. So if you had stayed on your 15-minute haul and never made your move, you're just going to be taken out earlier. Well, that's what I want. I want this to take me out earlier. Yeah, not if it goes up another 50 pips, you don't. So the potential risk in that transition between the 15 and 30, when the 30 just, the 30's in your favor and it goes, and maybe, of course I drew it in your favor earlier. I should draw it more like I'm trying to make it sound. So the 30-minute wave turns, red here. It goes from red to green. But see, that's going to be hard to do, isn't it? Why is that going to be hard to do? Because you've been in your 15-minute haul all along. So it's going to be a rare bird to see something like that, okay? And the point is, if the 30-minute wave does turn around and take you out, you would have been out with your 15-minute wave anyway. The difference is by staying on the 30, you had a chance for this thing to stretch out even further. Next thing you know, you're on your 30-minute haul, and literally you're at, 85 pips up in the trade. When do you go to the 240 haul? When the 240 flips in our direction. No, just put no different. No, on each time frame you have a haul. On your 1 minute you have a 1 minute haul. On your 15 you can have a 15-minute haul. On your 30 you have a 30-minute haul. You can get an idea when that 15-minute haul flips because they all flip when? They only flip on candle closes. Program so. It can't flip midstream. If it is actually flipped, we're not going to show it to you as green until the candle closes. We're not going to let you cheat yourself with premature exits. Oh, well, it's green. Yeah, but you still have 7 minutes on your 15-minute candle. No, you have to wait for the 15-minute candle to close and it still be green. So we program that into the haul. We're not going to allow live haul exits. That's why our haul is pretty special. It's not just a haul. Now, for convenience, depending on how you orient yourself, you can put your 15-minute haul on your 1 minute on your 1 minute chart in addition to your 1 minute haul. But if you're a 3-up environment, if you've got 30, 15, and 1, and you've got the natural hauls on each one, the local haul, so the 1 minute's the 1 minute haul, the 15's the 15-minute haul, 30 minutes, 30-minute haul. You don't need to have, you're sitting there right in front of it, And guess what? You're not in the trade. You can put a haul flip on your 15-minute haul so when you're in the 1 minute haul, you can put a haul flip on your 15-minute haul so when it turns in your favor. That's pretty cool. in case you didn't happen to look at the chart that's right there in front of you. Yes, when the higher time frame Hall flips, that's when you move your attention to that. These are only to stretch out pips in unknown zones. It is a robotic money management. It takes all the stress out of trying to figure out where to exit a trade, where it's going. The Hall is not designed to be a trade management system when you're at 12 pips and you don't know where price is going and it's stalling on you. The Hall is for runaway situations where price continues to move beyond your expectations. On your 30-minute chart, you have a 30-minute convergence. Man, how many times have you seen that thing snake on you? So instead of staying with just the 30-minute trade, you now switch to a 240 trade by allowing the 240 Hall to run the trade, assuming the 240 Hall is turning your direction. What I'm saying there is this. At the 30-minute level, here's what's going to happen. You're going to have a convergence. You're going to have a convergence. You're going to have a convergence. If you're trading here, I mean, I can tell you, you guys know, you see the posts in the group. Who stays in a trade past the 30-minute convergence? Nobody. If you picked up the Hall at that some point there because the 240 Hall is now in your favor, see, it's not, then guess what? So if the 240 Hall is in your favor at that point, this is going to go up. This can go all the way up. These are big pips. These are hundreds of pips. If you get out at 30-minute convergence, you would have exited there, you would have exited there, you would have exited there, because those would have been 30-minute convergences. If a 240 Hall is on there, it's going to allow sizable pullbacks to allow itself to come around and go back up. If you were trading 30-minute convergences, you would never get those pips. So this is a way of breaking the barrier in your head because you entered a 1030 trade thinking you can, I don't trade 240, I just do 30-minute. That's too much overload. Oh my gosh, putting a Hall on your 4-hour chart, waiting for it to turn green, that's overload? You can't handle that? The Hall is your MSL. The Hall is your MSL. In the lower stages of the game, your stop loss, your MSL, your ESL is 50% of gain. Once you got hundreds of pips going, you could up that to 40%. But initially, 50% of gain. So you've seen 4-hour trades just, day after day. They just essentially a bull run. They look like Bitcoin in the fall. Guess how powerful this is? Here's what you do. You can set your stop loss. So you can do it one of a couple of ways. We haven't looked at the 62 money map in sincere ways yet, but we will shortly. But it's pretty easy. I know where I am now. Watch how easy this is, and watch how fun this is. Here's price right now. I'm getting ready to go watch a basketball game. Here's price now. So what I do is I have some semblance of saying, if this grows to this point, so if this is 100 pips and it grows to 150 pips, if it went up there, where would my stop loss be? Well, it would be at 75. It's not half this distance. It's half of this distance. So my stop loss would be back here. So what do? I get a little notepad, little tiny ones, you know, the 2x5 or 3x5. And what I'm going to do is I'm going to set a price alert right in front of that line. I could do it right on it, just depends on if I'm 30-minute or 240. And what it says is when price gets to 150, and I have a price over there, you know, 1.234, make up a number. So when I get the alert that says price is hit 1234, so I'll have price alert in one column, and over here I have move stop 2. When it gets to 1234, oh, I'm going to have my stop loss at, you know, 1182, whatever the number is. So right over here, 1.182. So now I've got my stop. Here's my now price. I'm going to go watch my basket. Where's my stop loss here? Right here. That's in the trading station. I have a price alert up here, 50 pips more. If I get there, then I move my stop loss from here to here. So I set an alert for just under that price. I have one other alert on my chart, on this chart. What is it right now? It's my whole flip alert. So I'm in my den watching the game, and I get an alert, and I look, and it says one of two things. Whole flip, for which I open up my trading station on my phone, and I close the trade. Or it says price alert 1234 has been reached, for which I go to my trading station and I move my stop to 1.182. Totally remote managed. So it just depends on lifestyle. It just depends on your RAS growth. If you have a runaway move like this, you could probably trade pullbacks and make some good pips. That's chart time. Some people, I got all day to be on the charts. Great. Trade your pullbacks. Draw trend lines on the pullbacks. You will find them. Every two pullbacks, draw a trend line. Keep drawing every two until it's going to hit a third one at some point. One of those two trend lines, one of those two lows, one of those two lows, one of those two lows, the third hit's going to find, one of those pullbacks is going to find the third hit. Maybe it's such a nice move you can actually draw trend lines across the entire bottom. Who knows? But I'm just saying you can manage this 4-hour trade without even looking at a chart, just on 2 text alerts, 2 SMS alerts, 2 SMS emails, however you operate. One that says it's a whole flip, end the trade. 2, hey, you get to move your stop more. And guess what? If you're going to be away for a long time, I have a little pad and I've just got 1, 2, 3, 4, you know, whatever I want every 50 pips. In the case if you're using the money map, we'll show you how to do that. You know, the money map tells you at this price, move your stop to here. So I can have as many as I want. I could be in a trade 2 days, continuing to move in profit, never looking at the charts once. Because I've got alerts set for price gains, for where I should move my stop loss. Make sense? This is how you jump to upper time level trading, because, you know, I'll give you an example. I'll give you know one of Steve's corny analogies. You got a bucket, and we're going to call that your 15. No, you got a bucket, and we're going to call that your 15-minute bucket. And it just so happens that it's inside my 30-minute bucket. And it just so happens that 30-minute bucket is inside, make it look a little bit more scaled, my 240 bucket. And sure enough, my 1-minute bucket is here. So what happens is I'm sitting there and water's coming into my 1-minute bucket. And I get to a point where I'm watching the flow of water and it's real heavy. It's real fast. And all of a sudden my 1-minute bucket is filled up. See, I have some options at that point. I could go grab the handle of my 1-minute bucket and I could go home. That's exiting your trade at a 15-minute convergence. Or I could see this force and the bucket's full, but this is still coming full throttle. So I could say, let it overflow. And all of a sudden my 15-minute bucket's full. I can make a choice. I can get my 15-minute bucket and I can go home. And if the water just keeps coming with more force, soon enough my 30-minute bucket fills up. And when it gets full, I can grab the handle of my 30-minute bucket and I can go home. So the problem is with a lot of you, your minds are so limiting. Your RAS is so limiting. You have fear. You don't believe you deserve to catch 647 pips in a 240 trade. And so when that little 1-minute bucket gets full, hi-ho, to home I go. So you have a choice. There's nothing wrong with this. Look, 5 pips a day makes you a millionaire. The point here is to go to the 15-minute bucket, to go to the 30-minute, and let's go all the way. Let's talk about the 30-minute bucket now starting to overflow and the 240 bucket is starting to fill up. See, the thing with this, guys, we're not talking about 3 more months of study, 27 more indicators. We're talking about putting a Hall on your chart and setting your Hall flip alert. When the Hall at the next level goes in your direction, putting a Hall flip alert on it and moving your stop loss. That is not rocket science. It's not 27 more indicators. It's not 3 more months of study. It's a mindset. I can make more. I deserve more. And the money management on this is simple. You have an ESL to protect you, and you have an MSL, which is based on an alert. This will be automatic from the trade station. This comes via an alert. If your alert fails or you don't hear it or whatever, guess what? The trade station will take you out at 50% of profit. But if that 240 move was up at 647 pips and you got taken out at 323, I don't think you're going to cry too much. This is how you move into bigger pip gains with ease. All right. I don't have anything else to say about that. I would watch this video a second time. So far, it's pretty short. All right. It's 7:18. Well, it's 10:18. Do you want to finish off with Fibonacci levels? Not the Fibonacci training, but just Fibonacci levels? Or do you want to wait till Tuesday morning for that? It's not going to take long. All right, the majority are saying let's go, let's go. It's not going to take long. All right, so pretty simple. I've been trading 15 years. I probably didn't understand Fibonacci, really well, maybe 2.5 years into it. I was trading with it at a year, 38.50, 61.8. 23.6, what's that? But so I'd say about 2.5 years I kind of really got a handle on it. Maybe about 3.5 years to fully comprehend projections, Elliott wave. Didn't even know what an extended retrace was. All I was doing is projecting forward. Didn't have any tools I didn't have anybody teaching me. There was nothing out there. Since that point in time, the next 12 years, Fibonacci has been one of the things, as you know, I say Fibonacci rules the chart. So my main study has been all things Fibonacci. I've looked at the best of best institutional traders. I've read articles from Elliott Wave specialists. I've been tutored by people like Timothy Morge on pitchforks. Um, you know, it's it. And so what I found is that, oh, Trader X, and I'm talking 20 years on the charts, maybe an institutional trader, maybe a fund manager, he has this special number, you know, NNN point N%. And it's funny, in all my other reading, everywhere, I never saw that number before. But he puts it on charts, and wow, I see retracements to that point, or I see projections to that point. I'm like, where the hell has everybody else been? Why doesn't everybody else know that? Well, we've said it before. Sometimes, a lot of the times, really successful traders don't like sharing their stuff. They might share it because they write an article, but, maybe 1% of 1% of 1% Forex traders eventually see that article. I think I'm recording. It looks like I am. Yep, says it's still recording. I'm not recording in GoToWebinar. It won't let me record for whatever reason tonight. I'm using Snagit tonight. And then I go to Trader, pick a number or a letter. I go to Trader K. And sure enough, Trader K writes this article and blah, 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 and he talks about a retracement to this level. I'm like, what the hell? I've never heard of that level before. So 12 plus years of Fibonacci work, research, reading articles, seeing what one trader here does there, following people like Scott Carney since he put out his books in 2005, at least volume 1 and 2. Volume 3 out a year ago, June. Following people like Jim Kane for years and years and years, and seeing what he does. He's the king of Fibonacci research. He's the king of Fibonacci trading. Buying his material, his books, buying Carney's books, buying DeLogia's books, and reading hundreds and hundreds of articles. It's been a lot of time. So I have a compilation of all these secrets. Just like, you have the DC45, and I guarantee you, in terms of things like IML traders, in terms of traders who go to Google, if you take all the millions of Forex traders, spot Forex market, maybe know about the DC45. The 89, all of the sweet spots. Thanks for reminding me, Tim. All of the sweet spots in the harmonic targets. First of all, to think of the 62, who uses it, I mean, you're not going to see anybody unless they came through this house. Nonetheless, to put harmonic targets on it from a 13 cross to get to that 89 bounce, which when you see them, they are just sweet. Same thing there. So many few people know them. But let's get back to the Fibo. So I've done a compilation over the years. And Fibo is pretty interesting because what do you know? Why isn't that? Why isn't there this compilation of all these Fibonacci's out there? Why do you think it doesn't exist elsewhere? Because there's a paradigm of Fibonacci. Go learn, go Google Fibonacci training, and 80% or more of your hits are going to be talking about this like you're some first grader learning about Fibonacci retracements. No one uses them because the off number, the off ratio Fibos are too tight. Think of an old paradigm trader where he knows the 50% level. Can he handle a 477? He can't, because the slush he has, the stop loss, the size of the moves, the area of the zone that he doesn't know what's going on. If price comes back and hits that line, or 7 pips later it hits that line in terms of, let's say, a multi-hundred pip move, he can't differentiate line 1 from line 2. A new paradigm trader with harmonic wave convergence, tab 29, multiple time frame analysis down to the 1-minute chart in that data where we can see waves intersect, we can tell the difference between a 50 and a 0.477. And so I'm about to give you and show you my compilation of years and years and years of research, years and years and years of money to make you a better trader. Use what you want from it. Don't feel obligated to use it all. I've divided it to put it into usable hunks the best I got. Tim Packett says screenshot coming up. Segue. All right. After this session is over, I will upload these to the Precision Traders Group Files tab as 2 separate documents. One is the actual Fibo levels, and then the second is just what I've done with my templates. You do whatever you want, use whatever numbers you want, use as little as you want. I'm just putting it out there for those that want to take advantage of 12 to 15 years of trading and extensive investment in time and money in trying to find these. And I guarantee you, this list you will not see anywhere else in the Forex. You're not going to see this list anywhere else in the Forex. You may see a number here, you may see a number there. You're not going to see this list. So, running down from the top left, we have the Fibonacci retracements, and then we have Fibonacci projections, expansions, extended retracements, fork Fibos. I give you the value. I tell you the best that I know how it was calculated. And you want to talk about law of attraction? This is my compiled list. This is my compiled list going back many months. And interestingly enough, when I compiled it, there were 24 numbers. You know how many spaces TradingView has for Fibonacci numbers in their panel? 24. Law of attraction, baby. So we can get them all in one. All right, so then those are the raw numbers. So then what you see up here in columns, those are my templates. Okay, those are my templates. So here's all of the Fibo numbers 1 to 100 that I have collected. Now some of you, like Tim and Zoe and Richard, I don't know, 5-6 months ago, we brought the 685 to the table. I was doing some deep research and some stuff that Jim Kane had done, and he presented chart after chart after chart after chart where price left passed through the 618 and stopped before 786. And in fact, every one of them to the pit bounced at 685. So, I even said to the group at that time, hell, I've been trading 15 years and I've never seen the 685 mentioned anywhere. And I found one little article by Jim Kane and it had it. So that became, and we put on our charts, and oh my gosh, you saw me posting trades, and others started too, with the 0.685 as the bounce. You also saw, even before that, I think going back to, where are we now? This is what, February. So maybe in the late spring, Marianne texted me one day or messaged one day and said, "Oh, I saw this trainer, this educator, and he was talking about his past institutional dates, and the 941 was a Fibo value." And I'm like, "I've never heard of it. Give me the source." I started looking it up. Sure enough, square root of 886. Right? So this is a compilation over the years. A lot of these numbers. You could Google some of them and never find the source because even it's that deep. Same thing with our projections. Okay, a lot of these, Ralph Elliott with Elliott Wave, they're not highly publicized. Some of them, 1902. Never heard of that one probably. So this is a real strong list. I put a note down here. If you're in your reading, in your research, if you're one of those guys and gals that does that, and you come across a Fibo number that's not on this chart and you see it proven, in other words, the author is showing you charts that has it, please email me or text me or message me somehow the source, a link, and the number so I could go check it out. But you're not going to find this list anywhere else, guys. So what I did to make it comfortable in some situations is I chopped this up. And these are the groups or the headings that are the templates that I have. So the first one, as I said, is all of the Fibo numbers for retracements. So that's a template. Then I've got what I call basic, and these are just the normal, if you Google it, normal run. Then I've got, just for simplicity, my 40% stop loss. So I have one line and a red line across, and I can just put that on any chart. Just click template, click 400 stop or 40% stop, boom. There it is. That's my, right? Projections, same thing. I just put them all in one because projections are such that, there you have it. If it goes off screen, you're not going to see it, so it's no big deal. If you're in there and you have a 1272 projection, you get a hit, you don't need the rest of these. The 685 is way off the screen, but it's way off the screen, so who cares? You have the ability to toggle these off and on, obviously. If you don't want to use them, you don't want to use them. Then I have a set of templates called Elliott Wave. I haven't shown you the magic Fibo for corrections, and I haven't shown you the magic Fibo for projecting a 5-wave yet, but those are the numbers. And then it's real easy to do those projections based on having those numbers and then knowing how to use the Fibonacci tool. Your typical Elliott Wave retrace values. So if you're measuring Elliott Wave in its normal capacity, those are the retracements. Same thing with projections. Those are normal Elliott Wave projections. So if you can actually see an ABC going into a wave 1 and the wave 1 pulls back 50, 61.8 and it's a wave 2, now you could actually project out to wave 3 and wave 5. All that detail is inside the Elliott Wave module that we did in that video. Harmonic scans is a group or a set of templates. The 15%, and I know that's what the studies say, and I believe they say them for simplicity purposes, and again, they say them because they don't have the detail to measure anything other than that. I speculate that it's not really 15%, it's actually 14.6. It's just on most charts in most size applications, it's a hairline between the two. But to be technical, based on what I've seen and measured, those 15% hits are really at 14.6. Harmonic scans. Okay, if you look at every single scan that's available via Scott Carney, that includes not just the traditional harmonics, but things like the sharks, things like 5/0 patterns and stuff like that. There's a finite set of numbers that are used for his extended retracements, or he calls them projections, but they're extended retracements. So we have the retracement values and the extensions that are used in his harmonic scans. Pitchforks get a little complicated here. The reason it gets a little complicated is because TradingView has not yet picked up on any of my brilliant suggestions where they just take their Fibo panel and insert it in the format panel for the pitchfork. Instead, they limit your pitchfork Fibos to 8 values. So we have to get creative. So I've got Fibos for, or I got templates for internal Fibos. This would be quads. This would be, I don't know what the actual word is. This gives me 8 zones. I just call them ox because, as octagon or octagonal. I don't know what the actual word would be. If anyway, quads, ox. And then the actual Fibo values that we could put in. And again, these are designed for symmetry. So the 382 is going to be opposing the 618. The 236 is going to be opposing the 764. And you get a nice set of Fibonacci-based parameters, which makes it really cool to have in a template. Because maybe I have quads on and I see some turnarounds outside of the quad lines, and I could just hit the template button and say, oh, put on the Fibo ones, and boom, my pitchfork automatically switches to Fibonacci based. Works nice when I'm trying to align a best fit to be able to rotate and get maybe hits on quads, maybe get hit on the ox, or maybe get hit on Fibo based Fibonels. Warning lines, we don't have enough space to get out far enough with 8 values, especially if we're going to have midpoints. So I have one that goes from 1 to 4 warning lines, and then I have one that goes 4 to 7. So as we go past the 4th warning line, we just click on over, and now we'll pick up and go the rest of the way out to 7. All right. One thing that you've been cheated on a little, and it's because, it was so easy in Pro Charts, but it's a little more challenging in TradingView because how they've treated the Fibonacci panel for pitchforks. So, and that is this. I want to put a little bit of an angle on here. Excuse these for not being parallel. Price leaves our fork at some point. What do we instantly do? We have 2 things we traditionally do. First thing we can do is draw a fork Fibo. So we come down, it's just another name for an extended retrace in this case. Fork Fibo, we're going back until we hit 100%, and then everything beyond that we call a fork Fibo. Carney would call it a projection. I call it an extended retrace because it's extending beyond 100%. And we go up, and those lines are horizontal lines because it's true Fibo levels from that swing, just like any other Fibonacci would be. So there's our fork Fibos. We have another mechanism, and that is to go to the chart, go to the pitchfork, format the pitchfork, open up those panels, and put our warning lines on. And so then we get warning lines that are parallel, and we have midpoints to them, if dot dot dot. Then we have warning lines on the chart. And so we have ways of tracking this price when it leaves the chart. The trouble is when TradingView came along, or when we migrated to TradingView, I kind of dropped, especially in the teaching, because it wasn't handy to do one thing that we used to do. And the one thing we used to do was, in addition to warning lines, we used to have what was called external Fibonacci's. And that's nothing more than 1, 2, 3, 6, 1, 3, 8, 2, 1, 5, 1, 6, 1, 8, projections that are different than the warning lines, obviously, because the warning lines are whole integrals of the half channel. So we can't have all of those projections in 8 values. It just doesn't work. So the way to cover that is to cheat and use what they call Fibonacci channels. It's under the pitchfork. It's just deeper down, right below Fibonacci itself. And so we have channels, and I created 3 templates in those Fibonacci channels. So what you're going to do then is you have a pitchfork on your chart. So this is a little bit of wee work, but oh my gosh, if you can't do it, then just give up being a trader. So there's our pitchfork. What you do then is you go to the Fibonacci channel tool, and it's 3 clicks. I mean, it couldn't be easier. The first click, you just set on the pitchfork upper parallel. You drag and put the second click on your pitchfork parallel. The third click, you just come down here anywhere and click a third time, and now you have channel retrace on. You could shade this if you want, and you can have templates for your channel retrace. So I have 3 templates. One is to go from the edge of this line, which would be the 100% line, and go all the way out to 2. Look how many numbers we have in there, though. So I can go all the way out to twice the width, but with these numbers: 1.13, 1.15, 1236, blah, 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 19022. And then there's a second set that picks up from the 2 and goes out to 6854, which is the final projection in Elliott wave at the highest level. So 2 sets here: close work, farther out work, and then 1 set that has everything. So that's how I divided my sets. There might be better practical ways to do it. So what I've done, in case you just want to make it easy and outright copy this, is same chart, and I'm showing you the template menu that when you click on templates, you'll see. So for Fibonacci's, I got everything covered. So the all retrace will say retracement, all levels. The basic says retracement, basic. The 40% stop loss is retracement, 40% stop loss. Move right on into projections. There's only 1 column for that, so it's labeled projections. There are 4 for Elliott wave, so it's Elliott wave this, Elliott wave that. So the ABC is Elliott wave, magic Fibo, ABC. I don't know how these things tend to sort. Elliott wave, magic, Fibo, 5-wave projection, and that would be this column. So I show you what I name each column inside the templates. Just if you want to use that or call it something else, that's up to you. I was trying to match it up the best I could with the names we had as the column headers. Yeah, there was some time in that, Zoe. But you know what? There was no time in terms of sharing with you in building these template patterns because that's what I wanted in my charts. So this is the template pattern for retraces, including all the way through harmonic scans, including projections, retracements, Elliott wave. Pitchforks, quads, ox, Fibo, Fibonels, warning lines 1 to 4, warning lines 4 to 7, all on one menu. That's the pitchfork. When I go to the pitchfork format, those are where the templates will show up there. Here's the templates. Channel retrace, here you go. So that's where you'll find each one of them, or that's where you should place each one of them. Any questions about the naming conventions for the columns? Guys, we're about to take off. We're about to take off. So I have a little bit of announcement, and then I got to call it quits. I went about 20 minutes longer than I thought I would or should. Apologize. Thank you for sticking around. Um, so, my Fibo research was done. I still do it, but the opportunity for me to find something new and different than that I already have is very limited. Because there's only so many people who are leaders in the field, and they only publish so often, and it's going to take some brainiac, to come up with some new number that actually has relevance. Um, no, that's why I said these are not pitchfork. Over on the right, this is not pitchfork. This is channel retrace. You have to use the channel retrace tool. That's why they're greater than 8, because this goes back to the same thing as Fibonacci, where there's 24 values available. All right, um, so my time here the last many months has been studying harmonics patterns, understanding what Scott Carney is trying to do as a purist with harmonic patterns, seeing what IML does to take their interpretation of what Scott Carney does and what they deliver as a scan to the general public. Scott Carney has a methodology for determining the termination point of a scan. IML has incorporated that into what they present on their charts. And that's fine. That's good for, IML. But you guys are IML asterisk. You're IML asterisk precision traders. And we have this tool called tab 29. We have tools called pitchforks. And we have advanced Fibonacci stuff that nobody else in the world has. And once you understand what Scott Carney does as a purist versus what we can do with the data in a scan, of which IML is only showing one of 4 lines. In Carney's world, if price doesn't get to the green line, it's a failed scan. That's because he's a scan purist. I know there's more turnaround points that are generated by the scan that Carney won't talk about as trades. And part of the reason is if price doesn't get to the termination point, he can't, to the average trader, discriminate which one of those lines might present a reversal from a, and this is my personal opinion, from an ego standpoint or a proprietary technology standpoint, he also can't use those extra lines because it kind of invalidates what the scan's about. So from a Scott Carney perspective, the scan fails. Let me ask you a question. Do you want to be right or do you want to be happy? Now, it's best when you can be happy and right, but as a default, yeah, there you go, Ariel. As a default, yeah, rich. That wasn't the answer. That wasn't C above. That wasn't one of the available answers. Yeah, we want to be happy. So, what I'm here to tell you is that what Scott Carney will call a failed trade, what Quickfire will not qualify as a trade because it doesn't hit the line, and the traders then have to walk away and wait for another scan. There are valid trades based on Fibonacci lines that IML does not paint on your charts, that I know where they are, and I'm going to teach you where they are, and you can make tab 29 trades. Let me give you an example about purism versus pips in the bank. And then I have to wrap up and talk about what we're going to do with this knowledge that we have then. So Scott Carney says, no trade. And yet we sometimes see this. I wouldn't be surprised to see Scott Carney putting this in the bank. I wouldn't be surprised to see Scott Carney not putting these pips in the Scott Carney bank. He's just not going to tell you about it because it would destroy the reality of what this represents. With what we're going to do is we're going to know where these other lines are, and we're also going to know something that he defines as the ultimate stop, which is not necessarily the stop you see on your charts. So with harmonic wave convergence, we can discern these lines. With the lines on the chart, and you have this point, and it's a 15-30 minute convergence to the pip, that's a trade. Never becomes a quick fire trade, never becomes a scan trade, is a failed trade per Scott Carney. And it's just, it's just the way world's set up. You just put, 22% ROA in your trading account, and for whatever reason, Scott Carney says that was a failed trade. Well, he's talking about a failed scan. To somebody that can see inside this, it's not a failed trade at all. That is, as you all have just said, a happy trade. In terms of right or wrong, it may be the wrong time to take the trade per the scan, per this line, based on how Scott Carney has defined that entry point. All right. Also, this line is another Fibonacci number. So what I'm here to tell you is how these numbers get generated is based on, first of all, the first move, where almost, most of the patterns, that's 61.8. And by the time it comes down here, so we have X, A, B, So XAB is a qualifier for a pattern. If BC, if ABC is a certain number, now they hone on, they know exactly which pattern it is. So then they can go ahead and do this projection, for which IML won't paint until it's at 91%. But they can do this projection at that point. What if C is, and that's because of the nature of these Fibonacci's occurring in sequence. What if this number, what if this price goes up here and does that? That doesn't erase these lines from the chart. Remember, the scan doesn't generate these lines. The Fibonacci on the scan doesn't generate these lines. These lines are already there from the past. The scan is just showing you in the immediacy of your trading window that they're hot right now. And that's based on this move and then this move. The fact that it didn't make it up there does not remove them from being hot lines. IML, if this happens here, you'll never even see these lines. You'll never even see the green entry line. Nonetheless, the others. It doesn't mean they're not hot in the immediacy of where you are. One other thing. Think about this. How many times have you drawn an XA fork? And, you know, the best you could, well, I want to draw a straight line. The best you could, there was just no practical way of getting up to the D. You might have had great hits, and here sits your fork. Well, guess what? That might not be such a bad fork, because maybe the reversal is going to take place at the top of the fork right here. At the energy point of your fork and that line that isn't even painted on the IML charts. Who's happy? Who's happy? Oh my gosh, the amount of trades that we're going to be empowered because of pitchforks and understanding the technology of these lines. If you think Charlie Delta is good, if you think X-ray Alpha is good, wait until we fully unwrap this. Okay, here's the deal. Because I've had intellectual property stolen, I'm very sensitive to that reality. And, you know, even in the Fibos, I have a little trepidation for the, well, anyway, when you get this and you download it, look at this block. And all it really says is, these three guys have given you stuff that is just not protected very well because they're numbers. And it's hard to protect that. But they spent years finding those numbers. And they deserve something for that. So I'm going to suggest that, you know, all three of these guys deserve some level of consideration. It doesn't have to be today. But at some point, you want to learn more about what it is you're doing in the nature that it is and just absolutely see how brilliant they are. You know, you're going to want to go and buy one of their books or programs and drive your technology and your understanding deeper. I'm not saying today. I'm just saying as you move forward, if any of these numbers help you, you owe it to reward these guys somehow. That's just a personal belief. Okay. Now, let's go back to what I was saying. So we have all this opportunity here. Where's my mouse? We have all this opportunity here with, and I erased the lines, didn't mean to, with these scans. We're going to be bent on these scans more and more. It's not that Pitchfork standalone aren't good. It's not that Tab 29 isn't good. They're great. But you're talking about the hottest zone on the chart, and now we've unraveled the layers of the onions to understand the schematic of that hot zone. IML traders are not going to see that. They don't have the technology to. And Christopher Terry understands that. That's why they only paint one line on the chart. There's your go-to line per Scott Carney. And that's it. But the scan itself has the data for us to draw these lines. However, as I said, and I'm going to end here, just, and you might think this is crazy, but it's just the way I'm going to operate. Out of respect for intellectual property, and in some cases, even potential copyrights, we're going to have a group, and I hope this group merges real soon, but we're going to have a group, and I don't know, maybe I'll have to get Beryl and her husband to work to find a name. But essentially, it's going to be super scanners. And there's only one requirement. Well, there's two requirements. The first requirement is that you're a member of the Precision Traders Group, and that already has its own requirements. The second requirement are traders. I can't even get the name right for us, huh? The second requirement, because of the technology being used, you have to have or buy, oh, Steve, a copy of Scott Carney's Volume 3. And I have to validate that. So you have to send me the Amazon receipt or the store receipt or wherever you bought it. If you already have it, then you're going to take a screenshot of that book right next to your monitor with a tab 29 chart up on the screen. So I need to see a receipt from volume 3. I don't remember what I paid for it. I think it was $79. Anybody else bought it recently? So once that's done, so what's going to happen heretofore for the people that come into Precision Traders after today, they're going to have that book before they get added to the group. I would like to see 100% of our membership have this book. That way I don't need a different group to teach this stuff to and to trade with it. But in all respect to Scott and Jim, because he helped Scott with some of the stuff. He helped some of those numbers go back and forth. They were independent people, but they had projects they worked together on where they co-evolved some of these and confirmed with each other some of these numbers. But I just feel, you know, I don't feel right taking their technology, teaching it in a secret group where nobody will know I'm teaching it unless you guys reveal it. I just don't think it's right. And $79 or whatever it is not going to break the bank for the number of trades that we get additionally. Uh, you know, it's crazy. So that's where we are. Yeah, Harmonic Trading Volume 3. It's a pink cover or a red cover. $70 on Amazon, David Paxton reports. There you go. So what I'll probably do is give it about a week. I'll create this group, and then every time somebody sends me a receipt, I'll put them in that group, and we'll have, we're not going to go crazy right out of the gates. There'll be some posts. We're going to start stuff. Got some material to distribute that comes from within the books and some stuff that I've generated. And my hope is soon enough to just say that group's done, close it down, because everybody in Precision Traders has the book. But I don't mean to leave anybody out. None of this money comes to me. I'm not an affiliate for Scott Carney. This is just the way it is. And what I'm probably going to do, just so you know, because this was a little bit of a labor effort. Um, I probably you're gonna get it free. I said I'll put it in the group background, in the back in our file pages. I'll probably set up a little simple website, and for a whopping $11.95, you can have this chart. But I'm not going to collect the money. You're just going to send me a receipt from some charity that you sent the $11.95 to. So this is not going out everywhere. And if those that take, you guys will get this free. Precision traders get this. I'm just going to include it. But I'm talking about the IML community. I'll make it available. It's for the most part, it probably won't sell big because people aren't going to pay because they don't think they have to. Because after all, anything on the internet, anything about the forex is on the internet. And I can tell you that's not true because I got 12 years of testimony that'll say that's not true. Um, and for some that buy it, they won't be able to use it because they can't discern between these values because they don't have the technology to do so. All right, we're done. Thank you for staying in so long. 2 hours. Wow. It's Thursday, Friday for many of you. The weekend's here. Please get some rest, relax. We'll be going strong next week. And remember, life can be short. So, for those of you who have people in your lives that you care and love, please let them know you care and love them. I love you guys. Um, oh, any charity's going to work. Any charity's going to work. But you guys don't, it's not for you. You guys get this free. The only place I want you sending money right now is Scott Carney. you know, and maybe I'll send him a little card. Hey, Scott, I just sent, 40 people to you to buy your book. Um, all right. I'll see you next Tuesday morning. We'll see. Maybe the last, next to last, whatever. And then we might shake it up. Maybe I'll drop Thursday and do Tuesdays, but we'll alternate so everybody gets a fair shot at the live sessions. Y'all have a good night. Hopefully, I can stop this and the